All right, and we are live. And welcome everybody to the big picture. We're going through a technological advancement this week. So if there's any difficulties, I apologize in advance. But yeah, Robbie Chrisman and the Chrisman media team taking things to a new level here with the big picture. And yeah, hopefully we make it through okay. So here we go. But Rob, good to see you.
Good to see you too.
Any post MBA annual travel or what have you been doing since MBA annual?
Just living life,
living life. There we go.
And dealing with grandkids and odds and ends, and trying to get a little exercise. And in a couple of days, I head to Texas for the TMBA event.
Oh, I'll be there.
Really?
Yeah. So, yeah. I get in Monday morning, and then I think I'm leaving Wednesday morning. So, yeah, I'm sure I'll see you there. It'll be fun.
Yes.
Awesome. And I am Rich Swerbinsky with Onward and Upward Consulting. This is the big picture. Sorry for the kind of uneven start today. We're sandboxing some new tech, and wasn't sure really what the hell was going on until a minute or two ago. But the good news is this week we are super pleased. We joined special guest co-host this week, the Vice President and Divisional Sales Leader for CMG Financial. It is Natalie Overturf. Natalie, great to see you, and thanks for joining us.
Good to see you guys. I just saw Rob not too long ago. We're at the Idaho Mortgage Bankers Conference.
Yeah, the Pacific Northwest.
Yes. Yep. Good old Boise.
Boise, Idaho. There we go. So be a fun show today. Interested to get Natalie's take. Is leading one of the biggest divisions, one of the biggest IMBs in America. Just a competitive climate. It's been, a crazy few years in the mortgage industry, and yeah, just interested to get Natalie's thoughts on all the things going on in the mortgage industry. So, but Rob, would be remiss, of course, the Fed meeting yesterday, and your guy Jay Powell, he cut, but then spent like 18 minutes just dousing everything. I mean, it was the most depressing rate cut speech I've ever heard in my life, and I watched pretty much all of them, sadly. But Rob, of course, I go to you to get your thoughts on your guy Jay Powell's comments yesterday, and the Fed rate climate in general.
Well, yes, the rate cut was fully expected, so there was no surprise there. And for those of you who didn't watch the speech or pay attention to the news, what's going on is the big news, I think, was the Fed intending to change its policy of balance sheet runoff, ending that, but it'll still let the portfolio of mortgage-backed securities mature without replenishing them, and any funds from mortgage-backs, or I should say mortgages, paying off early, or whatever, money maturing, for example, will be invested in treasury securities. And I think that was, I don't know if that was a surprise necessarily, but it kind of set the mortgage-backed security market back on its heels somewhat. And it'll allow the Fed to maintain the overall assets that it owns at a relatively even level, but mortgage-backed securities will diminish somewhat. So it'll reduce the Fed's exposure to mortgage-backed securities. And like I say, I think that kind of set mortgage-backed security investors back a little bit. Mortgage rates actually went up after the news, and I think that was puzzling to many. But that's basically the reason. And other people said, well, mortgage rates have been coming down all year. It's okay that they go up a little bit, which I tend to agree with. Markets are like that. But if I'm Jay Powell, it's like, Natalie, we'll pick on you here a little bit. If Chris George contacted you and said, Natalie, we're going to be replacing you in 2 or 3 months, but just just ignore that. I mean, how can anybody really work in that environment?
It's tough. It is. It's very political, and I do feel like a lot of this is a little political, kind of like So that's my take a little.
On both sides, yeah. How long till Trump takes over the Fed, Rob? And more importantly, I mean,
Very sure.
gotta be soon, right? I mean, I felt like we couldn't fire him for like 8 months, and it's got to be down to like 5 now, right? I mean, how long till? So let's get all the Trump people in there. Let's get rates lowered and let's go to town. Come on.
I think April. Let's lower the rates to 0.
That Pulte wants to. Pulte proposed we're lowering them to 0. I think Trump has too. That might be a little crazy, but
Why not?
Yeah. I mean, I'm sure there's much smarter people than us to explain why that's maybe not sane, but
Well,
I mean, to be
we know it's
tad
not
more, a tad more aggressive maybe than they have been, but I know they're balancing a lot of data, but Trump now controls the labor data too. So, just a little bit longer till we're in the clear is what I think you're saying, Rob. No?
In the clear. I don't know what the natural or the obvious overnight Fed funds rate is. I don't know if anybody exactly knows what it might be, probably 2 or 3% or somewhere in there. But as we've seen, last September and again yesterday, lower overnight rates don't necessarily correspond to lower 30-year mortgage rates.
Mm-hmm.
And so I think the market is skeptical of rates. So Rich, even if they were to come in and I think the odds are good that President Trump will nominate and usher through his choice for the Jerome Powell's replacement. I think even if they were to lower rates to 0, the market would say, that's not so smart. And market determined rates like mortgage rates or treasury rates might not react like you might think. So anyway, after every one of our rate discussions, Natalie, just so you know, I always remind Rich that folks like you and folks that work for you or, LOs in the trenches, rates are going to do what they're going to do. They're out there trying to get the best product for their clients and trying to provide the best service and offer the best product, regardless of interest rate.
That's right. Well, yesterday we had the OB outage because of the Azure going down, right? So you had pricing changing, OB was down, it was very chaotic. Not a lot of fun in our world yesterday. Rates popped up. So
how do you handle something like that outage?
Well, we did manual. You just go to a manual walk. People just email in what what they need to do if they were trying to lock in. So timing was terrible, just really, really bad. So but we just did it all manually, and you just do what you got to do. And once again, technology is not infallible. So I wonder what the real story behind that outage was. I guess they're probably not going to tell us, but we'll see.
It's a little unnerving when these big.
It is very unnerving. We're in North for a realtor event here yesterday and today, and like she was flying Alaska, their systems went down for passenger check-in, so her flights were delayed getting out. So just the global implications of something like that happening, it is a little unnerving.
And it should be noted with our uneven start today that this show is sponsored by our great friends at Depth. And let's just say it plainly. Listen, if you are a service provider to the mortgage industry that is looking for better exposure, more business, a classy group of professionals to help manage your communication strategy, brand management, public relations, the fine folks at Depth, when I see them in action at conferences like I have these last few weeks, just always reminds me what pros they are. Carrie Milam, Leslie, Collie, Lindsay, Neal, great people. And if you're looking for a little help, Depth, the place to go. So I forgot to work that in the beginning. And, we love us some Depth here on the big picture. So,
hey, Rich, I've got a question.
Mm-hmm.
Given this new, Natalie, sorry to drag you through this.
You're all right. I'm enjoying it.
We are doing, trying some new software here. And typically I've been able to see snide comments, witty questions, who's on the call, who's tuning in. Rich, can you see that?
I can't see any of the chat. So if Robbie or any of the other Chrisman overlords, can help us with the chat. I'm just on the Google Meet, but we're on Zoom evidently. Hopefully our faces aren't red. It would look.
Somebody will tell us afterwards.
Yeah. So now
Rob, you got to airbrush. I'm getting old. You got to airbrush that shit out. I'm sorry. Yeah. So, but
normally, Natalie, I can see when somebody says, "Oh, Rob, did you lose more hair in the last week, or you gained a little weight, Rob, or Rob, you don't know what you're talking about." But in this software, I can't. So it's who knows what they're saying.
Yeah, exactly. It's kind of nice.
yeah. So if you're making comments in the chat,
Bliss, as they say.
we can't see them right now. So maybe we'll be able to. But Rob, one last thing before we dig deep with Natalie on all things retail mortgage banking in America. Have you heard anything, the LLPA cuts, any of your well-placed sources, LLPAs, G fees, anything further on that? We know they're looking at that.
You can look at it quite a bit. I think last week we talked about, and just for Natalie's benefit, when loan level price adjustments are put in place, they're not typically put in place willy-nilly. There's oftentimes a reason. If some company like Wells Fargo or AmeriHome or PennyMac or Rocket are servicing trillions of dollars of mortgages, and they are seeing a certain loss in a certain segment of their servicing portfolio, like non-owner occupied, they will typically put in a loan level price adjustment to make up for that loss that they are seeing in their servicing book. So just to obliterate those without regard to the actual performance that's going on with high-rise condos or whatever it might be, I think would be reckless. But I do think that the agencies are feeling pressure from non-agency channels who may not have those loan level price adjustments.
Right.
So I think that they warrant having a look at. I foresee changes. Will it improve the affordability? Perhaps, or nobody wants to be like, I'm really simplifying this quite a bit, but if everybody in the mortgage world has a 0.5 point hit for condos, and an investor comes out and says, well, we're only going to hit 1/4. Well, then they're going to get all the condominium business that's out there. And so it's kind of a situation where at some point that investor will say, wait a minute, all we're doing are condo loans. Why is that? Well, everybody else is at a 0.5 point. We're only at a 1/4 point hit. Well, then they're going to go back to the norm. So yeah, loan level price adjustments, though, there's a reason they exist. I think that there's some fluff there. And I think the agencies are looking at the market share that they've lost to, jumbo investors or non-QM or DSCR, whatever it might be, and saying, wait a minute, we might be able to change our pricing somewhat and compete better out there for companies' business.
Natalie, LLPAs, your thoughts on some of the talk?
Well, we're already seeing it internally here at CMG. We have some private label securitization we're doing on investment and second homes that the pricing, we can be 2 points better than Fannie's depending on the FICO and the LTV. So we're already starting to see investors have a real appetite for that because those are already priced up a little for their return. We also see some of the institutional investors coming in with an appetite for that. So there is definitely a market for those, kind of meet in the middle, the less than what Fannie Freddie charge, but more than what you'd get on a standard owner occupied deal.
Yeah, I think Pulte's kind of looking at it like, hey, this is like profitable, like, higher margin business, and we're losing it to all these private investors, and let's go get us some of that. So I think you're going to see the GSEs, it seems like they're deprioritizing, another public offering and prioritizing maybe using these the GSEs as offensive weapons, it seems like. So but
it's an interesting situation if you want to do a re-IPO of Fannie Mae and Freddie Mac. You want their bottom lines to look good, and yet today we saw Freddie Mac's earnings, in the billions. Fannie Mae's yesterday in the billions. 31st consecutive quarter of profits for Fannie Mae. Okay, 31 quarters of profits for Fannie Mae, And I wrote in my commentary, how many lenders or third-party providers can say that about themselves? Like zero.
Not many.
Yeah. So
You
yeah,
see
it'll
CMG's
be-
not gonna make 40 billion this year, Natalie?
Maybe just a titch under that, maybe.
That's like the GSCs. They're going to make like $40 billion this year. And to Rob's point, very few other people in the mortgage industry are making money. Like they've just got like the stranglehold at the top. And, I mean.
It is a little wonder that they want to take it out of conservatorship a little bit. It's a cash cow for the government right now. So it makes me scratch my head a little bit on what the desire is there. But I do think a little bit of it's public opinion. There's a lot of the public doesn't feel like those agencies should be part of the government agencies. So
I think honestly, I think it was Trump and Pulte at the beginning just saying we generally are in favor of deprivatization. We know their value is at sky high, so we got to cash out on some of this opportunity. Then they looked into like what actually you have to do to cash that out. You're like, oh, wait a second.
Maybe not.
Like, hey, we could just keep these on here and we do all this cool shit with them. It seems like is the thinking, but who knows? So
it could change tomorrow.
Change tomorrow.
This administration.
So Natalie, how did you, we as everybody in the industry likes to say, nobody goes through grade school and high school and beyond wanting to be in mortgage banking. How did you achieve where you are today? And what did you do after high school?
Well, I went to college right out of high school. Thought I wanted to be a lawyer and made it about, my path was very zigzag. Made it about almost 2 years in college. I was just telling Rose for this story. I went through a super bad breakup with my boyfriend. And I was just tired of being a broke college student. I decided to drop out of college after 2 years. And I just saved some money and go back to school. And I got a job as a temporary receptionist at US Bank's mortgage department in the early 90s. And in 90, if you think back, 92, 93 is right when rates were coming down from the highs, the late 80s. And so they had a little refi boom and they needed a processor. And so I moved right into processing. And 6 months later, I met Galvin Ray Birch. I'll never forget her name at Pacific First Bank at a realtor sipper. My loan officer had taken me with him to introduce me to all his agents. And she's like, you're in the wrong job. You should be a loan officer. So I literally moved into being a loan officer like 9 months after I had college. And so that was a different day, I would say, in time. And I hit it kind of right at the right moment where there was a lot of loans to practice on. I got a lot of things wrong. I got a lot of things right. But the one thing I did not realize starting in my early 20s is that rates go up. Nobody told me that. So in 94, if you remember, rates went into the 9s and I'm like, holy cow, what just happened? And I hadn't saved any of my money. Luckily, I was still single and no kids. And I had a really good girlfriend that was a broker of a real estate office in Vancouver, Washington, which is outside of Portland. And I moved and took an in-house real estate loan officer job with John L. Scott. And that's kind of where I really started. I feel like my second phase 2 of my career, where I really started focusing on realtor and developing relationships, and been doing mortgage ever since. I mean, that was the start of my journey. So I definitely started, at the very beginning of the kind of the entry level position. And here I am today as, VP of a division. And it's been a 28-year journey, right? So a lot of years to get here.
Do you wish you'd bought real estate everywhere you worked?
Oh my gosh, I'll tell you what, like we definitely got, had opportunities to buy real estate along the way, but not as much as looking back now, I wish we had done more. In this business, I got a little risk averse with the markets. Like, you just don't know on the income. My husband's a teacher, right? We had a family, and it's like, you don't want to be super speculative, but we've done okay on our real estate investments over the years.
And you're also
oh, go ahead, Rich.
I was just going to say, also the co-owner and co-founder of a pretty fabulous spa in Coeur d'Alene, Idaho. I did a little, website due diligence before the show, and it's really fabulous.
It is fabulous. We've had it for 6 years now. I have two amazing partners that are the operator owners, right? And I do like the kind of the marketing, the books and the financials, kind of the offsite stuff. We all kind of stay in our lane, and it's been a great business to be in, and the complete opposite of the mortgage business. Like you couldn't get more different. So as far as the customer, they come in happy, they leave happy, it's kind of crazy. It's fun.
Rich, are you thinking about going in for a treatment sometime?
I've never been to Coeur I've never been to Coeur d'Alene. I've heard it's amazing, and it's grown like crazy, right, since the pandemic.
It has. It was a little gym that not a lot of people knew about until COVID, and we got a little overrun. So we're suffering the growing pains right now of what that looks like, but it's a great little town. It's like a little Lake Tahoe, mountains, lakes. It's really beautiful. Little resort town.
Love it. And what's the name of the spa so people can Google it and look it up?
Yeah, it's Beauty at the Lake. That is my
Beauty
spot.
at the Lake.
Yeah, it's beautyathelake.com.
Rich has a house on a lake, and that's what they say when Rich is in residence there at his house. They say, beauty at the lake.
Yes.
Actually, we don't want to go too far down that path. But when you are dealing with, it's not, how much of your daily life is dealing with borrowers? You're overseeing a territory, right?
Yeah, so my division today, we've grown a lot. So I am tracking to close. I think I'm going to close 520 million this month. So I've got a lot of originators underneath that are working their butts off for that volume. So I think I'm right about 250-ish loan officers in my division today. So I don't really face borrowers unless there's some type of customer issue that only the bad stuff gets to me. Typically, I'm not talking to the customers for, the occasional servicing issue or whatever you might have. So,
right. Yeah.
So borrowers, realtors I talk to a lot, but not borrowers.
Yeah. When you get to your level, I would think a good day is when you don't hear a single borrower's name.
Yes. And I will tell you, when you build your machine right, that's the way it should be, right? Things get taken care of at the line level. It doesn't have to get escalated, and you don't have to get involved. So focus on
you have all these originators. If you had to pick the top 3 attributes that you've seen in your 28-year history and of the successful originator LOs that are in your division, can you pick? What is there a common trait that you see?
100%. I actually have those I can answer those because we were just talking about that at my last sales meeting. Number 1 is mindset. Like there's just no two ways about it. Like the people that are willing to grind and stay above it and not get into the doom and gloom, and that can just stay focused on moving the needle in their business, stay positive, take care of themselves. It's part of the reason I love owning a spot, kind of holds me accountable to self-care and making sure I'm doing the right things, because health kind of leads everything in my opinion. But mindset is huge, I think. And I'm not talking like sitting and meditating, I'm just talking about staying positive, surrounding yourself with the right people, having the right team around you is a big one, I think. Number 2, a lot of our really successful originators have found a niche in the market. Like they're, the saying, there's riches in the niches, right? So they, it's not like they don't do all kinds of loans, but like, we have our all-in-one first lien HELOC product. That's a big proprietary product for CMG. So I have some originators that are crushing it with that product, right? They're doing other loans, but they've also made in fact, I have a gal in Seattle that closed last year. I don't know where she's going to wind up this year, but last year she did 50 million just in all-in-one product, right? So she's created a real niche for herself. We have some that do builder, new construction. We have some that, do first-time home buyers, whatever that is, they've found kind of their niche where they can dig in and be the expert. And then last, I think, is the database. They have stayed in contact with their clients. They're game ready. Like when rates drop, they know like they've got a strike rate with their client. They're reaching out. Like Danny Meyer, he's our number 1 originator in our division. I think Danny's been closed 30 million personally this month in production in October. And he locked like 32 refis on a Saturday. Like he just went in, he had his clients ready. He was just banging them out. So, so to me, those are like, if I had to pick three things, that would be it.
Okay. One other question I have before Rich takes the center stage here
Okay.
as beauty at the lake.
I love the PR for my spa, so say it as many times as you want.
Well, I think you should have Rich's face on your marketing material.
Not with not my face or Lake Erie. You're better off Idaho and Natalie. Yeah, trust me.
This issue comes up time and time again. I know there's some people on this call that I've asked about compliance and regulatory issues, and how much do the rank and file originators care about changes in regulations or changes in compliance, or is that kind of an afterthought? They just hope their compliance department tells them what to do, and they don't follow trends in that sector of the business?
Yeah, I would say that really varies from originator to originator. I'll start there. I do think it's leadership's job to inform them, making sure you kind of filter the message where they can metabolize. You don't freak people out about compliance, and you don't take the craziest approach out there. Everybody needs to be compliant, and I feel like we do a really good job of not managing to that lowest common denominator. That's really where I think you get in trouble with originators, and you start, you're going to take the most conservative and extreme stance on every issue. It's just can be tough. So I think originators today, for the most part, are very aware of RESPA and LO Comp and, kind of the big ones. Sometimes we run up against UDAP and different things that they're, maybe haven't run into before with something on doing their website or different things. But I think for the most part, most LOs are willing to be compliant. They don't want to get in trouble and, are pretty good stewards.
Okay.
This is the big picture, presented and sponsored by our good friends at Depth. If you are a fintech that needs your story told, Depth, the team to do it, depthpr.com, or get a hold of Rob or I, and we'll get you connected with Carrie, Leslie, Lindsay, and the fabulous crew at Depth. So, Natalie, the competitive climate, it's been a few tough years. The big IMBs have gotten bigger. We've seen a lot of consolidation in the industry. What's it like right now? Just, being one of the big faces for one of the biggest IMBs, in the market, and recruiting into that.
Well, I think there are some real advantages with scale. So I want to start there. I never have aspired to work for a top 5. It's just never been something that I've put on my bucket list because I do think
too good at your job, it's
you do get, additional challenges with size. But what I really think you get are today, it really matters your ability to scale and spread your costs out over more production, right? And your cost to produce is a huge part of this business and being able to operate profitably. So I do think it's very important to have scale, whether you're small, mid-size, or a large company. The secret is to figure out how to act small when you're a big company, and to be flat and nimble, and to make sure you have autonomy and you can make decisions quickly, because speed, is what you need in this industry. You have to move fast. And so I feel like today platform matters probably more than it ever has in my time in the industry. The company that you sit with and what they can do for you in product, innovation, tech, scale. That doesn't mean CMG is the right place, but having a company that can invest, the cost of investment into technology is massive, right? And Chris George said something I'll never forget on one of our all hands calls last year, where he said, technology is like painting the Golden Gate Bridge. You get to the end and you're starting over, right? And it kind of that constantly you're moving the ball on that. So that's my view. I think you can be successful. Great originators can be successful on Mars. So it doesn't really matter. The self-source, street warrior will figure it out. I do think there's some advantages when you have a company that can, help you, keep your costs down, which you can put into pricing and comp and marketing and tech and all the other things you need today.
The broker side of our business basically doubled market share since the pandemic, about 24-25%. Have you been able to, a lot of LOs have left to go the broker route. Have you been able to insulate yourself from that? Your thoughts on the rise of broker market share in the industry?
Yeah, I actually think I actually worked for a broker for a short time in my early career. I think the broker channel is good for our industry, quite honestly. Competition is good for us and creates innovation, and you have to be competitive. So I do think there are some good things about the broker channel. I think the models are so different today that an originator that's attracted to me and my team and my tribe and my platform isn't going to be the originator that's going to want to be on the broker platform. So we really haven't lost. I do not, maybe one or two, and we're usually our lower unit originators. I have not personally at this point, I'm knocking on wood, lost anybody that's doing significant volume to a broker. Part of that is control. And the reason that I was attracted to the IMB platform is I like the servicing, I like the in-house underwriting, I like to have everything inside. Now I know some very successful brokers that they have figured it out and they have those relationships, but I do think you're still one removed from the person that's writing the check to fund that loan. And, sometimes you need the special decision or the special favor. And I think that's a little tougher in the broker world. So my preference is IMB, but I have a lot of friends that love working for a broker. So it's very different models today.
And then how do you view like banks and credit unions right now, just competitively, as competitors?
I think, they're the steady eddies of our industry, right? They've got the low cost for deposits. They can beat you on rate, but they're in a tight box. And so actually, if you look at, I was just looking at who's NBA's economist, Mike Frantantoni, is that how you say his last name? His last stat was like 70% of purchase businesses go into the IMBs. So the banks have really lost share because they can't, they're not doing non-QM. They're not really working outside of the box. They don't want to do anything and there's a lot out of the box right now, right? A lot. So we need them because they fund our warehouse lines. There are some things you need them for. And like I said, creates competition in the market. And I always think competition is a good thing, but it's a different lane than we drive in.
Yeah. And last question for me, just in the kind of competitive climate part of it, in the recruiting world, any emerging trends in what originators are looking for out of a lender?
Well, I always laugh. Originators want everything. They want price, they want marketing, they want comp, they want highest comp, lowest rates, best marketing, best technology, right? So I think that's a common denominator. I think what I have found, and we've grown a lot this year, and the recruits and the people that I've been able to hire, they're looking for someone to invest in them and help show them a future, right? Like a vision for them, not the company, not my division. What's the future for you and how can I help you get there? And so I do think companies that are investing in, internal, I run a coaching program inside of my division that I do. Just, it's not a company program. It's something that I do weekly. I do a call with my team, and those things set you apart because most companies, I would say, aren't doing those kind of things where they're taking those extra steps to work with their people, help them reach their goals. And top originators are looking for that today in a different way.
Absolutely. So P&L model versus corporate model, a big, obviously debated thing in the industry. It seems like things have gone way more P&L these last couple of years as things have gotten more competitive, but I would cede to you on this.
Well, I have both in my division. I have some, we call them partner branches. So I have both. What I would say I think they're both good models. There's a right team for the P&L model and there's a right team for a retail corporate model, and they're different, right? And what they want is different. And I feel like we are very consistent in the standard, and the expectation around profit and, how you run the branch. So, I have some teams that have always been on a P&L type model, and, we weren't going to land them unless they came in under a P&L model, and we hired them and it's worked out great. And I have people who are just as successful running on a retail model. I do think there's two things I would say on that. Number one, I think more companies are going to try and press on the P&L because it forces profitability in a different way than a corporate structure, right? And so that benefits the company, not necessarily the originator, because I do think the retail model can be a little kinder in a down season. So, you're just not hit with, those negative, losses, that accumulate in in a tougher season. So, but you also are capped on the high side, you know, a little bit. You don't get the full upside. You just don't get the full downside. So it really depends on the preference of the team and what they're doing in volume and how they want to operate. But we can accommodate both models.
How have you seen in the last several years the reasons why a loan officer or a branch might be looking around?
Mhm.
What motivates somebody who's actually takes your phone call or takes a recruiter's phone call versus those who don't? Is there anything going on out there?
Well, I would say lack of I think two things. Number one, usually it's support and leadership. I mean, that's always first, like local support and leadership, and how they're awfully, which sometimes comes down from corporate, sometimes not. So I'd say a lot of it's just the support they're getting and the leadership. The second thing is, I think people have been, and I think we've come out of that a little bit, they have been nervous about stability of certain companies and whether they were going to be able to make it through, and you know, are they going to be around? So we certainly have talked to originators who are reaching out, like, I need to make sure I've got a plan B, you know, if something, there was an event that were to happen. I do think, you know, we hit hopefully we're through the trough and we're climbing back out, and we're not, you know, going to be as pressed, but margins are still very pressed. There's a lot of companies that are still struggling to be profitable. And I have actually seen more this year. I have been shocked that typically the recruiting season starts, you know, really in the fourth quarter. You're talking to people and you're hiring people to start before the beginning of the year, but we've really been steady all year long with hiring great, you know, originators to our team, which is different. That's different. Usually it's not as consistent throughout the year. Usually it's right, you know, first and fourth quarter. So yeah, that has been a little different this year.
Interesting. Yeah, and I know that people obviously don't want to leave a pipeline. And
Yes.
as pipelines have increased somewhat for some lenders and some originators, you know, they don't want to jump ship. So that is interesting though. And that's something that I've heard from others, is that
Mhm.
if you give an originator, you know, support and attention, and don't leave them out to dry, they tend to be more loyal. And it seems like if I were to ask you, how long has the longest tenured originator been in your division? How long?
I have an
Who's been there
originator.
the longest?
Yeah, my team has been through 4 acquisitions together. So I have many on my team that have been with me since First Horizon days when Rosemary and I were there. So, I mean, I have people back from 2003 that are still on my team. So, I've got many from.
There you go. Well, that
still.
says a lot about you.
Well, I think it does speak to me, but it's really our leadership and our culture at large. Because we do, you know, like you said, people are looking for investment and support, and we are a very high performing culture, and we kind of live by the 5 dysfunctions of a team, the book by Patrick Lencioni, you know, the pyramid of trust, you know, up to high performance. And so we've grown up. I think part of it, Rob, is we've grown up together in the business. When you've worked together for 20 years, you know, you learn a lot, you fail a lot together, you kind of go through all the things. It's like a marriage, you know, and you just get to a point where you got it figured out. And so that's, you know, I think we're pretty special right now. I feel like our team is special, that we've really got a really amazing thing here. I mean, my credit leader, my ops leader, you know, Rosemary and I, we've all worked together for 15 to 25 years. So it's,
Yeah. Well,
yeah.
Rich, I know Rich has cycled through 5 personal assistants in 5 months. But
It's like
because of
2
the-
years, but yeah.
because
so.
of the agreement that they sign when they go to work for them, they're not allowed to say why they leave. So we'll never know.
Oh man, yeah. Good thing that's all on the down low for sure. So Natalie, a lot of talk at MBA annual of like real estate services and mortgage under one roof. A lot of talk I heard like of being able to broker and banker under the same roof of the same mortgage company? That anything that you guys are looking at, or your thoughts in general? People are very one way or the other on this, it seems like.
I want to make sure I'm understanding your question. So, meaning a loan officer be able to do one thing, or
So I speak rich.
okay. Let's be sure.
So
I think I got it.
In certain parts of the country, loan officers are becoming real estate agents and vice versa.
Okay.
So is that a trend we're going to continue to see, or does CMG say, no, that doesn't work, figure it out one way or the other?
No, say that doesn't work, but I feel like we have a pretty specific profile, and that's not our model at large. And so we will make exceptions, and we do have a couple of loan officer / realtors on my team. So, but it's, we're very choosy about that exception. We're predominantly, master of one thing, which is mortgage. And I do think it's tough when you start trying to bifurcate that. I mean, I look at Rocket when they discontinued their realtor program a few years ago model. I just don't think it's going to ever be the predominant model.
It's tough.
Yeah, it's tough because I would think, I've never been an originator, but I would think the skill set is somewhat different. And if I'm a loan officer and I generally work Monday through Friday, the last thing I want to do on a Saturday, half an hour before dinner time with my family, is deal with somebody who wants to put an offer in on a home, and I need to write it up.
I think more the trend would be, especially if the market really returns and margins are a little healthier, maybe more joint venture opportunities for big real estate offices. And we have a full JV division at CMG. So we do already have some real estate, mainly real estate, but if you build our JVs. So to me, that's probably more the opportunity, I think, in the future, is more of those type of partnerships. Because most great agents, they don't want to be a loan officer. They want to be a great agent. And most great loan officers don't want to be a real estate agent. I'm not saying all, but I would say the vast majority.
Yeah.
Natalie, leadership visibility of women in general in the mortgage industry, it was been so bad for so long, and it feels like it's getting better. We try to be part of that solution with the show, have been really since day one. But your take on like where that's at as we sit in 2025?
Well, I would say we have some work to do. I mean, I look around, I think when you get to the branch manager and when you go to the regional and divisional level, it's much harder to see women in those seats. I think there's 12 divisionals here at CMG. I think I'm the only female divisional. Now, once you get above me, we've got 50-50 men and women in the EVP seats with Rosemary and Tammy. So, but just that, it's very tough and I think that's twofold. Number one, I don't believe and this, people might not agree with me, and that's okay. I don't believe there's inherent discrimination happening here. I think it comes to, and I can just go by my own experience. There was an HP study done that showed that men are willing to raise their hand when they feel like they're 60% qualified for a job, and that they'll self-promote and say, I'm your guy. Women, do you want to take a guess on how ready we have to feel before we raise our hand and say, I'm your girl?
90, 95?
100%. We have to feel like we're totally qualified before we say, hey, pick me. And so women, we need to get better at self-promotion. We do. We're not very good at it. Women, we want people to tap us on the shoulder and tell us how great we are. And men are just better at it. That's just a fact. I see it all the time. In fact, I think of an event I went to recently where I saw one of my younger sales managers tell my regional that he's gunning for his job. I don't have a woman that would have sat there and done that, right? So he's like been in the business for 6 years. I'm like, okie doke. So it is a real thing. So I think part of it is educating women, like this is the path, this is how you do it, and we need to get better at that. The second thing is we need more men to call it out, to say, hey, you seem like this would be a great path for you. Are you interested? And what can I do to help you? So I think it's twofold. Women, we need to figure out how to self-promote and raise our hand and be more vocal to ask for the seat at the table. And we need the men to say, hey, you know, you're qualified. Let's talk about what this looks like, either to be a branch manager. So, I mean, we found a lot of success with taking our successful younger females that have aspirations for leaders, putting them into sales manager roles, teaching them how to build a team so that they can grow into those branch managers. I have 2 on my team today that have done incredibly well, you know, going down that path. So you need a model for it to show them what it looks like, but it's absolutely possible. And it's good to have, you know, a diversity of viewpoints, men and women. We have strengths and weaknesses. I mean, I don't want to broad brush it, but there's, you know, women, we do some things better than men. So it's good to have women on the team for sure. And I'm attracting a lot of very strong female originators right now because they're looking for women leaders. So companies are missing out if they're not investing and looking for those opportunities.
Very, very well said. And Natalie, we appreciate you so much for taking some time out with us to be on The Big Picture this Thursday. Thank you so much for being on and your awesome insight.
No, I appreciate you guys both so much, and hope you have a happy Halloween. It's my orange today.
Halloween. That's right.
Halloween tomorrow.
Yeah. Halloween plans? Do you hand out candy, or do you turn the lights off and hide in the basement?
Are you talking to me or Rob?
Rob.
Oh, me. I thought he was talking to you.
No.
I'm not hiding in the basement.
I've got a 2.5-year-old granddaughter who will be Rafiki.
Okay, so you're going to be on the beat. You're going to be.
I will send you, anybody who wants to shoot me a text, I will send them a picture of Cosette being Rafiki. It's like the cuteness scale goes bonkers.
Natalie, your twin daughters that just turned 21, if I remember seeing correctly.
My daughters just turned 21. They're in college. They're juniors in college. So yeah, their birthday's in October. So Halloween was kind of always a national holiday around our house. So I kind of missed it a little bit, but they're coming home for Thanksgiving, which will be fun.
Walking around with the wagon behind them, some kind of adult beverage and a Yeti. Yeah, many years in Cleveland. So it's a lot of times like 28 degrees, and you know, but
so I am not saying I missed that part of it, but I do miss some parts of it.
Well, we appreciate all of you for joining us. Sorry we weren't able to see the chat today. We'll hopefully get that ironed up before next week, but we appreciate all of you for taking time. If you're listening to the pod, where most of you consume, or watching on YouTube, we do the show live every Thursday, 3 p.m. Eastern. Typically have a couple hundred in the audience live, and you can go to ChrismanCommentary.com to get signed up for all that. So, but thanks again to Natalie, to Rob, and to all of you, and have a great rest of the week and weekend, everyone. We'll see you next Thursday.
Adios.
Bye, guys.